Welcome to Financial Focus, brought to you by GulfCoast Financial Services founder and CEO, John Kuykendall. John and his team of financial, legal, and tax professionals have been providing North Florida savers and investors sound, comprehensive financial guidance for over 30 years, helping you to achieve important life and planning goals. Be sure to like, subscribe, share, and tune in for more Financial Focus by visiting GulfCoastFinancial.net.
And welcome into the program. This is Financial Focus, brought to you by the best of the best in financial services, 7 years and running, as named by the readers of the Lake City Reporter, serving North Central Florida savers and investors, the team from GulfCoast Financial Services, and founder and CEO John Kuykendall here with us, as always, providing the guidance and perspective on the financial world. And John, in these uncertain and quite frankly scary economic times, how do savers and investors keep a sane mind and a fundamental investment approach that's going to help us make forward progress toward our goals?
Well, Peter, hopefully that they've done the income plan and they've already gotten that predictable, sustainable income that we talk about all the time through Social Security, pensions, annuities, and life insurance, so that we know that in any time we've got enough income coming in that we don't have to hit our growth bucket, which, as you know, right now that growth bucket's in the toilet. I mean, it's way down. The market's in bear territory. It's very unstable. It goes up one day and down the next for about the same amount. So, hopefully they've been diversified enough and they've worked on the plan ahead of time. But if they hadn't, now's an ideal time to sit down and come up with an income plan that gives you that income that you can live on so that you can have the kind of retirement that you want. Otherwise, you're going to run out of money because you can't keep taking money out of the market when it's down 30% and you're trying to live on it too, Peter. We know that.
Yeah, but to paraphrase, having an income plan equates to confidence in times like these, John?
Yeah. I mean, the income plan gives you that peace of mind. You know that no matter what happens, you've got enough money to cover your bills. I just met with a client this morning, and unfortunately, both her and her husband are seriously ill. And we're sitting down working up an income plan so that she knows that they will have enough money coming in each month to pay their bills. I mean, that gives you peace of mind, Peter, knowing that I've got what I need to pay my bills. And, if the roof leaks, I've also got a reserve fund that I can pull out for that. But that income plan gives you that diversification and that flexibility to do what you need to do in these times.
So when we talk about income plan, John, and I know we've talked about the 5 planning mistakes to avoid. You talked about not having a grip on retirement, a guaranteed retirement income plan. With the income plan component of our total financial picture, you are talking about streams of income that are durable, dependable, reliable, and maybe most importantly in times like this, will not fluctuate just because the market may be down 15, 20, 25% or more, which does happen from time to time.
Well, that's true. We know that in cycles that the market's going to go up, the market's going to come down. We can't continue to believe that we're going to live in the market. That's why the average investor makes 3%, is because they get in at the wrong time, they get out at the wrong time, and they don't have the confidence to stay and not worry about it and make sure that they're diversified. But that income plan that we're talking about is making sure that every month I know that when I go to the mailbox, I'm going to have enough, I'm going to have a check that's going to cover all my bills and my living expenses for that month.
And there are certain components, there are certain factors that go into and make up the income plan. Social Security, a dependable, durable stream of income that doesn't fluctuate with the market. A pension from a company for those few of us that are still lucky enough to have those. Theoretically, does not fluctuate, does not depend on the direction of the market, and we can count and rely on that. And then, John, there is another component here that we're going to talk about today, and that's our personal guaranteed source of income offered through annuities. And I know annuities are widely debated for what they can and can't do, but At their core, annuities make up an important part of this income plan component, and that's been recognized pretty widely and across the board.
Well, it's even more recognized recently. I mean, the government's come out with some suggestions on annuities, making them okay for 401k plans, other things. So annuities don't have the stigma that they used to have when certain people were talking about how bad they were. Annuities will give you that private, I like to say private pension fund. You take your money and you create your own pension. And so that's what we have to do. Most of us in America today is because we don't have that defined benefit plan, that pension income that's going to come in every month from our work or from the state, wherever we work. We have to create our own. And we want to make sure that no matter what the market does, that check's going to be the same check or an increasing check as the market goes on. So we want to make sure that we can guarantee predictable, sustainable income coming in from the insurance company every month. And annuities do that. Fixed income annuities, which can get some of the market, but not all of the market, they will give us that income. And also, don't forget, they also work for a long-term care benefit. So many of them, if we structure them properly, will double that income if we have 2 of the 6 daily living conditions that we can't meet, so that it gives us a little bit of long-term care protection too.
I saw some recent reports, John, that showed and detailed how those with higher amounts of net worth, particularly the bands that I saw over 500,000, had a much higher prevalence of owning annuities and increasingly larger percentages of their total net worth in annuities. Now, never all in, never all of your eggs in one basket, so to speak, but relatively speaking, a higher percentage of their total assets and investments went into different diversified types of holdings, and annuities were a larger portion of that. I also saw that recent studies are showing that annuities actually can make for a pretty attractive bond alternative when comparing the interest rates, the income rates, and the relative safety or potential fluctuation and risk of principal that is inherent in bonds and bond funds right now.
Well, I'm hearing that more and more, Peter, that annuities are kind of like a bond alternative. And, if we think about it, bonds were meant to be conservative, and they didn't go, they worked in opposite. They were non-correlated to the stock movement. So if stocks were down, usually bonds were up, and if stocks were up, bonds were down. It doesn't work that way anymore. The bond market's down just like the stock market, just not as much. So annuities are conservative. They can give us that fixed yield like a bond does, and at the same time, they're not correlated to the stock market. So no matter what the stock market does, it's not going to affect my fixed income annuity balance, because I get a zero. I can never go down. I can always go up.
And just for kind of perspective, bond funds on average year to date down around a little bit more than 10%, whereas, John, the annuities that we are talking about that are fixed or fixed indexed, no losses because they don't have the risk of market losses. So even with the market down, even with bonds down, these types of annuities that we are talking about in particular are principal protected, don't have the same kind of risk of market losses. And you've mentioned a couple other factors that annuities can do, but if you would, take some time and break that down. What are the strengths and benefits? And then we'll also talk about some of the drawbacks that we need to be aware of with annuities.
Well, the strength is that it will give me a predictable income that at some point in the future I can take. The other thing that's a pro about it is it's low fees. It's either low fees or no fees. The one we looked at this morning was 1% for the income rider. We have many that are no fees, so they're low cost. The main thing is that my money, I get a percentage of the market. I don't get all the market, but I get a percentage, and that percentage will go up. But like you said, if the market's down, then that year I get allocated zero. I don't have to take the losses. So Also, another thing is that some of them can be structured so that we get increasing income. So if I have a good year in the market, then as my balance goes up, my income will also go up for that year. And conversely, if I don't have a good year, my income stays the same. So it gives us that predictable income that we talked about. The cons of it are that I get a percentage. I don't get all of the market. So if the market's up 10, I may not get 10. I may only get 6. But at least I don't take any risk. So from a conservative standpoint, it works really great like a bond because it is conservative. It does have low cost, and it does give us a predictable, sustainable income.
Now, it's important always to understand what you are investing in. And you mentioned several qualities there. It is equally important to note that while we are discussing these qualities that can be available in annuities, John, there's one specific type of annuity that we are explicitly not talking about when we talk about safety of principal and removal of market risk.
Well, that's right. We're not talking about variable annuities. In fact, I just met with a client yesterday who brought in an annuity from another advisor, and they had actually had less money in it now than they had put into it 10 years ago. And that's because in a variable annuity, is subject you're subject to the market. The sub accounts are in the market, and whatever the market makes, that's what the sub accounts, which are mutual funds, are going to give you. On top of that, they also have high expenses, so that 2 or 3% that the insurance company charges has to come out on top of that. So in a down market like this, they'll lose a lot more than a regular annuity, and in an up market, they'll probably make more. But it's a lot of risk, a lot of exposure. If I've got a growth bucket and I'm in the market anyway, I'm not sure that a variable annuity really diversifies me that much.
When we hear the conversation about how annuities are so overly complicated and complex, John, do you think that this is one of the reasons why there is that perception, is that there are several different types of annuities that really do very different things, so it's hard to describe what an annuity does with a very general conversation without getting into the specific type?
Well, I think you're right, Peter. There are a lot of moving components when we talk about sub accounts, when we talk about, indexes, and we talk about puts, and I've got spreads and I've got caps. And so there's a lot of different components. They're really not that difficult. Your financial advisor should be able to explain them to you. A cap means I can't make more than whatever that cap is. So if I'm in the S&P 500 and my cap's 3, but it made 10, I can only make 3%. Participation rate means that I get to participate a certain percentage in that index. So in this case, if the S&P 500 made 10 and my spread was 40, then I'm going to make 4%. So that's not that complicated. It's just that I think we haven't done a good job of education, and we probably made it more difficult than it really is. I mean, even for us advisors, it took us a while to kind of figure out the difference between spreads and all this other stuff. But they are very simple. They are complex. But, the thing about it is, whether you've got a variable annuity or whether you've got a fixed indexed annuity, every year on a fixed indexed annuity, you get to move that index. So if you're not happy with it, I can make a change. On variable annuities, I can move those sub accounts anytime I want to. So if the market's down, I can move them. But the problem is people don't do that. And so they let them sit there for years and years and years. And as you know, what's in vogue today in the investment market isn't going to be number one tomorrow. And so they miss the opportunity to make a lot of money because nobody is really servicing these things. Once you get paid for them, the advisor gets paid for them on the front end, they tend to forget about them. And you, as the investor, need to make sure that your advisor is looking at those.
Maybe one of the biggest downsides is an advisor, a source for financial guidance that isn't there to provide that ongoing financial guidance. And in that case, John, it really doesn't matter what type of vehicle you are in. If you're not getting the guidance that you have trusted somebody to give you, and in many cases that you're paying for, then you're not going to get the best results, period.
No, Peter, and that's another reason though, Peter, why you need the income plan, because every year in the income plan, we look at those. And if you time it right, you should be able to at least get those things reviewed once a year.
Well, and another reason why, John, not all of your money in any one kind of place or any one financial vehicle. And another reason why having that income plan is so important is hedging against principal loss, but also hedging against reduction or fluctuation to income. And both of those components, principal protection and income protection, can be reassuring for at least a portion of your assets or your income, especially in markets like this.
That's right, Peter, they can. And we need to do that. I mean, you need to make sure that when we have these markets, and we will have them, I mean, just because we had 13 years of great run doesn't mean that the market's not going to correct. And it has. And we don't know when it's going to come back. That's another thing. People, they try to time the market. We don't know when the market's coming back. We don't know when it's going down. We can only guess. And so we tend to, as individual investors, we intend to get out too late and we get in too late and get out too early, or we get out after it's already down. We need to have that income plan and have that diversification, have that income set so that we know we got that income. And then no matter what the market does, I'm okay. I can sleep at night knowing my growth bucket may take a hit, but it's going to come back because over time, the growth bucket will come back.
Well, John, I know that we have already seen a volatile market, and unfortunately, investors have already lost money here in the first half of 2022. And I know it's the news' job to kind of sell catastrophe, and headlines always lead that bleed, is the way that I've heard it put. And it's an unfortunate reality, but the scare tactics are what is effective. However, I am hearing a lot of people saying, hey, the worst is still potentially yet to come. We're talking about recessions. We're talking about the possibility of even more major downturns into the future. Is now still a good time, or is now a good time to take action and look at principal protection, look at putting that income plan together? What are your thoughts and opinions on where we have come from, where we are today, and where we're going as far as the timeline for a good time to put a plan together?
Well, I always remember the guy in 2000 that predicted we would have Dow 36,000 before the end of the year 2000. We didn't make it. So nobody knows what the market's going to do. But, the thing of it is, Peter, if I'm thinking about my index, and my index, whatever I have in an S&P 500, it's from year to year, point to point. So if I take out an annuity right now, 1 year from now, I'm gonna get my gains. So do I believe that between now and next year, the market's going to stabilize and go up? Yeah, I really believe that. And so if I was going to invest in an annuity, now's a really good time to do it because we've already taken the losses. We're already down. It's a great time to get in, get the rest. And if we go lower, then your balance is still protected. But I've got a chance of making quite a bit in the next reset, which will be this time next year.
Well, in defense of Harvard economist Terry Dent Jr., who wrote several books, we did eventually hit 36,000 on the Dow. It was just about 22 years after he had predicted. He did also predict a subsequent stock market crash. And he said the Dow may go down to 6,000 in that book. And he attributed a lot of that to the demographics of our society and an aging baby boomer population. He said that, the consumer portion of that generation's lifespan was during their peak earning years and in retirement would not be buying newer houses and be as a consumer driven oriented demographic group in population, and that would, along with other factors, attribute to any subsequent stock market crash. He actually looked at Japan as the example and the reason for the thinking on that. But we don't know where the future of the market goes, John, long and short of that. And what may look like a loss and a low point today into the future may look like it would have been a good time to move some money to safety.
Well, I think that, we don't really know, but I think that the market moves in cycles. Sometime this year we'll hit the bottom. I mean, we know that. We don't know whether we're there now or whether it's going to be another 20%. But whenever it is, it'll be there. And if you have that principal protection plan, you don't care because you're protected, your income's coming in. And so, from my standpoint, like I said, I believe in a year from now, we'll be out of this. It'll be over somewhat. We'll be back up. The market will rebound. It always does, always has. If you look at the market over a long period of time, the line's straight up. But if you take it in 10-year increments, it looks like an EKG chart. And that's the reason the market goes up and it comes down. It has to. It just has to weed out some of the exuberance and some of the, speculation out of the market. And it will do that. It just self-corrects itself. We know that. But if you've got that principal protection income plan in place, you don't care. You don't care where the bottom is. You don't care where the top is. You know that you got enough money to buy groceries. And that's the main thing. Now, the Fed's saying that by the fourth quarter, inflation is going to be down to 4.5%. If you believe that, then I think by the time we get there, the market's going to correct. So sometime this year, I think the market's going to take a turn up. But if you'll remember, I now say that, and I'll probably be gone for 12 years. Harry made that prediction in 2000. He didn't come back out really until about 2016 or 17. We started hearing from him again. So I don't know what he did during that time, but it's amazing how everybody's got 5 minutes of fame, and it's which side of the coin they want to take. And so sometimes, it's like I told somebody this morning, it's kind of like that commercial you saw on TV where the girl said she was dating a French guy, and the guy said bonjour, because that was the only French word he knew, but she believed it because it was on the internet.
Obviously true, because it was on the internet, right? Well, John, if savers or investors are worried or concerned, if they're properly positioned, if they would like to have protection of some of their principal, if they would like to have protection for their income now or into the future, if they would like to have that income plan, what's the next step? What should we do?
Give us a call, 755-9018. We'll be glad to sit down and work with you. The consultation's free. The income plan's free. If you decide to implement it with us, then we'll go forward and we'll explain. Our fees are all up front. We make sure that you have everything you need at your hand. But it's so simple to get that income plan. It's just ridiculous that nobody really does. But, as I told somebody the other day, we are great people at trying to do the right thing. The problem is we do something and then we try to do something else. We do something else. And it's kind of like adding on to your house in a hodgepodge. I met with a client prospect yesterday that we had 14 accounts that we were trying, and nobody was watching them because they were spread all over the place. That income plan will bring all that into one focus, one view, give you the kind of definition and understanding you need, and we can work up that principal protection plan at the same time.
Give GulfCoast Financial Services a call, 755-9018, 386-755-9018, if you would like to take John and the team up on that offer for the complimentary review, the construction of that income plan. You can take a look at it and figure out all the pieces, how they fit together. Are they working cohesively and in unison? So that is a service of the team from GulfCoast Financial Services that they offer and extend to you as part of this program. So just give them a call, 755-9018. That's 386-755-9018. John, always appreciate the conversation and perspective. Thank you for being here, keeping us financially focused.
Thank you, Peter. Have a great week. We'll see you next week.
Be sure to like, subscribe, share, and tune in for more financial focus by visiting GulfCoastFinancial.net. The information presented on this program is provided for informational purposes only, without warranty of accuracy, completeness, or suitability for a particular purpose. This program is not intended to be and does not constitute financial, investment, legal, or tax advice. This information is general in nature and not specific enough to be construed as advice. You should not make any decision based on the information presented on this program without independent consultation with an appropriately licensed professional or competent advisor. Investment in securities or the market involves a potential risk for loss of principal. Trading, therefore, may not be suitable for all listeners. Annuity guarantees are based solely on the financial strength and claims-paying ability of the issuing company. Withdrawals of growth from annuities may be taxable as ordinary income in the year it is taken. Individuals should review contracts for specific details of the product's features and costs. Early withdrawals may subject the owner to penalties, fees, or taxes. John Kuykendall is registered with and securities are offered through Kovac Securities, Inc., member FINRA SIPC, found online at www.kovacsecurities.com. Advisory services are offered through GulfCoast Financial Services, Inc., a registered investment advisor in Florida. GulfCoast Financial Services, Inc. is not affiliated with Kovac Securities, Inc. or Kovac Advisors, Inc. Past performance is not indicative of future results. All investing involves risk. Investment decisions should be based on your own goals, time horizon, and tolerance for risk. Due to various factors including changing market conditions and/or applicable laws, the content may no longer be reflective of current opinions or positions.
Guarantees are subject to the claims-paying ability and principal strength of the annuity issuer. The S&P 500 Composite Index is an unmanaged group of securities considered to be representative of the stock market in general.